A very good morning to all. Thank you for joining on this Saturday morning. So, so the topic for today's webinar is venture investors shift from mutual funds to PMS. So, firstly, is there any necessity to move from MF to PMS? Like it all depends on the investors' expectations and their suitability and what they want in their financial investments. So, is that mandate? Is that a mandate to shift from MF to PMS once you become a big investor? Absolutely not. So, so for which kind of investors are we doing this webinar? So the main target audience are basically for investors who just become a big investor, meaning they would have started 5 or 6 years back, like before or post COVID, and somehow in this 5 years, uh, your portfolio might have uh, become a quite substantial amount, a significant investment portfolio of maybe 50 lakhs to 1 crore. So a lot of investors are in this category, right? So this webinar will be absolutely useful for you. Uh, so now initially I'll just give you an introduction on what mutual funds are and what PMS and their pros and cons. So as you all know, mutual funds are a ready-made portfolio, meaning there will be a separate fund manager who will be able to look after your investments. You just need to invest your amount time to time, and they'll absolutely take care of the portfolio on what stocks to buy, uh, when to sell, when to rebalance, and everything. The only thing is, so here, let's say a large cap fund for an example. If there are 1,000 investors, all the investors will be having the same portfolio because they'll pool the amount and they run it as a fund, as a single portfolio, and each investors will be allocated units. So it's completely transparent and it's regulated by SEBI and AMFI. And one of the best advantages of mutual funds are it's almost available to everyone. It's very cheap. You can even start with a minimum amount of 500. And for new investors who want to start their financial investments, who want to save and disciplinedly invest, I think mutual fund is one of the best product available in India. Whereas now let's come into PMS. Portfolio management service is kind of an enhanced version of an MF, where the ticket size is around minimum of 50 lakhs as per SEBI mandate, and each and every investor will have a separate portfolio, where each and every portfolio will be customized based on the investor's risk appetite and their requirements. And unlike an MF, here the deployment strategy would differ, and all the money won't be pooled, but rather be maintained as an individual individual portfolio. And there won't be much of a diversification, unlike an MF. Here, in most of the PMS, they take a very concentrated approach of maybe 25 to 35 stocks, and it will be best. It will be better suitable for high net worth individuals. And for MF investors who've been doing MF for a very long period of time. So now let's look at the pros and cons of MF. So first, the advantages, like I mentioned, it's you can even start with the bare minimum of 500,000 just to test the waters. Once you get conviction and once you're able to, build that trust, maybe you can scale up, and also you can diversify your investment amount into various funds, various categories, and it's also very tax efficient. Meaning, if you're running your own portfolio, whenever you sell a stock, you need to pay capital gains tax in form of short term or long term. But whereas in mutual funds, if the fund manager makes the changes, the investor need not be able to pay capital gains. That's one of the best advantages of mutual funds. And also in terms of liquidity, whenever you want any amount of money, you can just put a redemption, and you don't need to sell all your units just to put your redemption. Maybe whatever amount you want, you can put that as redemption. So in terms of liquidity, it's very flexible. And one of the cons are not much. Only thing is, uh, since there is a fund manager, you as a investor, you just need to invest the money and you need to trust the fund manager, because they are the ones who absolutely take all the investment decisions and management. And another thing is, there might be front running happening. It has happened. Front running is basically, once all the investors give money, right, the fund managers will make investments on certain scripts, right? But what if uh, they actually, buy their investments prior to what, making their investors money? So since the volume might go up, right, so they might benefit from this short-term spike. So front running is one thing where like some fund houses has already done it. So that's one of the disadvantages of MF. And now let's go into the advantages and disadvantages of PMS. In terms of PMS, the main advantage is you get a unique portfolio. So each and every investor's portfolio would be unique and customized. It mainly depends on what time of the market they enter. So let's say in a mutual fund, uh, almost all of the investors will be having the same stocks, and regularly there will be changes. And in all of the clients' portfolio, the changes will be happen. It's not necessary in PMS. In PMS, each and every client's portfolio will be different, and each and every portfolio would be having a different set of strategy based on the investments the PMS investor makes. And also, the strategy wise, the position sizing, risk management, and the deployment strategy, everything differs from uh, MF to PMS. In an MF, the fund manager is supposed to, deploy 90% of the cash into equity when before the market closes. Whereas in PMS, when the investors gives 50 lakhs, there's no any mandate to deploy the whole 50 lakhs in a single day. We can even, deploy the capital slow and steadily over a period of 3 to 6 months. But whenever market corrects, they can even deploy 60-70% on a single day. So it's everything based on the opportunities markets gives. And there's so also there's I mean, it's not necessary that when you invest in PMS the returns will be more than MF. It's definitely nothing like that. But there's a potential where a lot of much alpha can be created in a PMS due to the high concentrated investments they're making in stocks. And the main disadvantage is the entry barrier. Only with a capital of minimum of 50 lakhs, you can invest in a PMS. And also there are liquidity constraints. So when you want to redeem, you need to make sure that you don't go below your invest minimum capital of 50 lakhs. Let's say, for example, just you've invested 50 lakhs. If you want to take 10 lakhs, then you need to close the PMS. Whereas in the mutual funds, there's absolutely nothing necessary like that. You can even continue with the balance 40 lakhs in the MF. So there are some liquidity constraints which persist in PMS, and the performance is mainly due to the fund manager. So both MF and PMS are like investment vehicles. So it doesn't mean that only PMS will give more returns than MF. You need to actually mainly trust the fund, and you need to trust the right fund manager. You need to identify the correct fund and the correct fund manager. Then it really doesn't make a difference or on where you're going as in MF or PMS. So another aspect which PMS investors should maintain is that mainly one thing is that when you want to shift from MF to PMS, you need to emotionally, have some expectations, and you need to reset your thinking actually. The first one is uh, it's basically PMS in returns are more cyclical actually. So the first thing you need to keep in mind is you need to come in for a very long term period. So if you have a very short term time frame of 1 year or 2 year, definitely I think uh, PMS will definitely not be suitable. You need to give a time frame of at least 5 years, because all the investments which we do are for 5 years. We try to invest for a particular market cycle, and we try to invest in undervalued pockets of the market. So there might be phases where the returns are very flat, or like, let's say for example, right from 2024, September 2024 to now, February 2026, almost the markets are at the same level on index level, right? So the returns, it's absolutely difficult to make returns in this level of market. So there will be a phase where returns will be very lumpy. So you can't get annualized returns, sort of an FD kind of return. The returns might come, the first 2 years might be a scenario where the first 2 years you won't be able to make money, and you will be getting the rewards in the third or fourth year. So it generally works like that. So you need to, tolerate the underperformance periods, and there will be drawdowns as well. So you as an investor should be, you should ask the question that will I be able to withstand a 15 or a 20% drawdown? So if you're, comfortable to see a 20% drawdown in the portfolio, then definitely PMS would be suitable for you, because it has happened in the past. Uh, so you need to be, need to have the stomach to bear the drawdowns, and you also need to be comfortable to own a portfolio with a very concentrated portfolios of stocks. And like I mentioned, you need to have a time frame of 3 to 5 years. And also, in terms of performance, like I mentioned, uh, it's at the end of the day, it all depends on the correct fund and the fund manager. Really, it really doesn't depend whether mutual fund or PMS. So, in PMS, there is a chance to, generate more alpha, and most of the stocks which we invest actually are away from the index actually. Let's say, for example, your typical NSE 500 index comprises of all the 500 stocks with a different weightage. But we try to, even move away from the NSE 500, and we can even, invest in micro caps as well. And also on the sector weightage, some of the sectors in the index will have a very low weightage. Whereas if you're very positive on that particular sector, we might even increase the weightage in the particular sector. And when we do all this, there might be a phase of underperformance, and there will be a phase where the returns will come even for the first and second year on the third year as well. So, can you completely, should you move your MF to PMS? Let's say, for example, you've built a portfolio of 50 lakhs or 1 crore. Should you completely stop all the mutual fund investments, and should you start a PMS? Definitely not. I think your core should always be, the base can always be mutual funds, because mutual funds are very simple, and they give decent returns when you invest in a correct fund. And you can use PMS as a layer on top of this base. So your core portfolio can always be mutual funds, and your satellite portfolio can always be a PMS. So one example which we can give you is 60% of your overall equity portfolio can be in mutual funds, and 40% can be in PMS. Or another example is that for your equity investments, you can consider PMS, and for your debt portion, for that guaranteed returns which you want to get, right, uh, like 7 or 8%, you can do these investments in debt mutual funds for stability. Whereas in this concept, your equity PMS portfolio will keep on growing, and whenever the market corrects, also you can even redeem some amount from the debt portion, and you can even add it in the PMS portion. And you can even pair your PMS with an MF. Let's say, for example, if in just to give you an example, we have our flagship PMS product, which is Solitaire, which follows a FlexiCap PMS approach. So in Solitaire, basically, we can invest across large, mid, small cap, and even the micro cap. the benchmark for this product is NSE 500. The only thing is in solitaire, we try to invest in very quality companies with the good quality management, and we try to avoid companies with debt. So mostly 80% of the portfolio will be in debt-free companies. So since we only invest in debt-free companies, we avoid banking stocks because banks' main business model operates on leverage, right? So we generally avoid banks. So what you can do is you can start a solitaire and maybe you can match this PMS with a mutual fund, with a banking mutual fund. So you can actually invest in both PMS and mutual funds, and you can pair this as a product where both the PMS and mutual fund would complement each other. So let's say, for example, whatever opportunities your PMS product can't capitalize, maybe we can invest. You can invest those opportunities in the mutual fund. Let's say, for example, if you're investing in an equity PMS product, right? And last year, gold and silver had a great upside opportunity. So what you could have done is you could have continued your PMS investments. On the other side, in mutual funds, you could have bought gold ETFs, silver ETFs, gold mining funds. So you can actually complement your PMS and mutual funds so that all the opportunities are capitalized across the products. So this is also another great strategy which you can follow, which we also follow this for our investors. Even if a PMS investor onboards, we ask them to open a mutual fund account as well, so that we can complement and take opportunities on all the available opportunities in the markets. And even right now, we're doing the same. So for our solitaire and the flexicap PMS investors and Vriddhi or small cap investors, we're asking to invest in PSU bank index funds and China funds, where in these funds these are domestic equity products, right? So they can't invest in international funds or and in solitaire they can't invest in banking. So we complement these funds. So we'll also now look at when not to shift to a PMS. So first things first, when your capital is only 50 lakhs, definitely I think you should just stay and let your MF portfolio grow to at least a crore. So that's definitely one thing you can do. So if you only have 50 lakhs to invest, then you can absolutely continue to do your mutual fund investments, because once you want to transition from straight away from mutual fund, which is 50 lakhs to PMS, the transition won't be that smooth, because once you sell your mutual fund investments, you need to pay capital gains tax. So the transition won't be that smooth. So what you can do is build your portfolio to a crore or 75 lakhs, and then maybe take out 50 lakhs and keep the balance 25 lakhs in mutual funds and let both the investments grow. And another thing when not to shift to PMS, if you have a very short-term goal of 1 or 2 years, and if you need that amount after a year or two, then definitely I think you can. It's safe to continue in mutual funds. And when you're near to your when you're near to your goal, it's better that you realize your capital and start moving it to a safer platform, safer investment asset class like a debt kind of a strategy. And another thing, when not to, move to PMS is when you can't scale up after the initial contribution. Because generally, PMS, the initial 50 lakhs alone is not enough. You need to at least, keep adding additional capital, at least whenever the market corrects, so that we can capitalize on the future opportunities once in a while. At least you need to contribute uh, a yearly once, or maybe you can even do an SIP on top of this PMS, or you can keep contributing on a quarterly basis. But some level of additional participation is required from the clients initially, at least for the first 3 or 5 years. So now let's look at the common things in an MF and PMS. Both mutual fund PMS are when we specifically talk about equity category, both in PMS and MF, it's a long only strategy. So the fund manager only invests in a long-term view, and they only invest in the spot market. There's no any kind of derivatives or futures and options involved, unlike an SIF or an AIF. So in terms of MF and PMS, both are a simple long-term equity investment products. So that is common, and that is the reason why I say you just can't go to PMS just for the sake of returns. So it doesn't mean that you can make high returns in PMS and not in MF. There have been gold standard mutual funds which have given better returns than PMS in the last 5-10 years. So that's the thing of what I'm talking about. If you're absolutely comfortable to stay in MF, you can even keep continuing an MF journey and not invest in PMS. In terms of if you want to, if you're very if you're very, thinking about cutting down the cost, and if you want a very tax efficient way of investments, I think MF would be suitable. And if you're much worried about not able to manage your MF portfolio once it gets big, maybe we can be able to help you even on managing an investment as a PMS or even as an MF. And another common thing is, uh, you as an investor, be it as an MF or PMS, should have a time horizon of at least 5 years, because when the fund manager, even in an MF or PMS, all of them are investing in stocks and they invest for long term. And like I said, at the end of the day, it all comes down to choosing the right fund and the right fund manager, be it a mutual fund or a PMS. So this is one of the most frequently asked question, even from our clients. So I just wanted to end the webinar by addressing this question. So can MWs can MW investors shift from uh, mutual funds to PMS once their portfolio crosses 50 lakhs? Like I said, we ask the clients to keep continuing for a year or two to build the portfolio to 75 lakhs to 1 crore. And we ask them to move it to PMS so that we can run both MF and PMS so that they complement each other. And another strategy which we ask for our PMS investors is we can even invest in two PMS. So if they have 1 crore as a capital to invest, maybe we can even do the solitaire and sphere part, because sphere is a multi-asset PMS product, and I thought we manage. I mean, the investment approach for our mutual fund and sphere all are same. So we do a multi-asset investment approach. So solitaire would be a pure equity flexicap PMS, and sphere would be a multi-asset PMS. So you can complement solitaire and sphere with 50 lakhs each, where the equity components gets completely covered in solitaire, and there will be equity component, good amount of equity component with sphere in large caps and banking, where the banking question is complemented because solitaire won't be having the banking part. And also sphere, since it's a multi-asset fund, it can invest in mutual funds, ETFs, precious metals, rates, international funds, so that all of the opportunities we get are covered. So that is one more strategy which we can invest and which we can suggest for you. So that's about it from my end.